Right. So let's start now. You can remember last time we were discussing on tutorial number 4. So we have completed the adjustments. Right. So we have completed the accounting analysis. Now you can check your answers. You can check your answers. In 2019 accounts, right. Now you need the completed or adjusted financial statements. So once you have adjusted financial statements, you can do the financial analysis. Now you can check your answers. You see 2019, we have adjustment to administrative expenses, over depreciation 14, and this is adjusted administrative expenses, 1728. Adjusted administrative expenses, 1728. Then we have another adjustment to finance cost. You can see bank loan interest 33. Bank loan interest 33. Then adjusted finance cost 41. Adjusted finance cost 41. Then adjusted profit before tax 2932. Adjusted profit before tax 2932. Now you see profit before tax before adjustment 2951. Adjusted profit 2932. You see profit declined by 19. Profit decreased by 90. Then you can calculate the tax effect. You can calculate the tax effect. We have calculated the effective tax rate. You see effective tax rate 30%. Then tax effect equal the change in the profit multiplied by effective tax rate. The change in the profit multiplied by effective tax rate. 19 multiplied by 30%, 6. So when the profit before tax declines, tax expense declines. So tax expense declined by 6. Tax expense declined by 6. Then the profit for the period declined by 13. Profit for the period decreases by 13. You see adjusted profit 2053. Adjusted profit 2053. Right. So this change in the profit for the period, you need to adjust to the retained earnings. You see profit for the period declined by 13. Profit for the period declined by 13. You need to adjust this to retained earnings. So retained earnings declined by 13. Retained earnings declined by 13. You see adjusted retained earnings, 800 multiplied by 13, 787. 787. Right. Then we have adjustment to property, plant and equipment, that over depreciation 14. Then property, plant and equipment increases by 14. You see the adjusted value. Then current assets same. There is no adjustment. There is no adjustment to current assets. And there's adjustment to tax payable. There's adjustment to tax payable. You see, income tax declined by 6. You see in your statement of income, income tax decreases by 6. When income tax decreases, tax payable decreases. So tax payable decreases by 6. Tax payable decreases by 6. You see adjusted tax payable 214. Adjusted tax payable 214. Right. Right. You see under non-current liabilities, bank loan is 333. We studied this, right? So we have calculated the bank loan balance at amortized cost. Then the rest of the items are same. Rest of the values are same. You see total assets, adjusted total assets, 9,337. Adjusted total assets, 9,337. That's equal to the total equity and liabilities. That's equal to the total equity and liabilities. Right. So in 2019, you see total assets equal adjusted total equity and liabilities. But remember, after doing the accounting analysis, total assets is not necessarily be equal to the total equity and liabilities. You see, there are some adjustments because of that. These two are not equal. So what we need is, we need to bring financial statement values to acceptable amounts, right? Appropriate amounts. So here we don't pass any double entries. We analyze the financial statement items. If certain items values are not appropriate, you do some adjustment to bring them to appropriate amounts. Right. So this is for 2019. Now what you will do is these adjusted values you can separately take, or you can bring to a separate sheet. Now you can say the next worksheet, financial statements adjusted. So you can name the next worksheet, financial statement adjusted, right? So you can take the line items. So you can copy and paste the line items. You can copy and paste the line items to a new worksheet. So we don't need effective tax rate. Right. Or you can keep it. It doesn't matter. Right. So we have 3 years, 2019, 2021. Two thousand 2020 and 2021. Then the adjusted values you can take to this worksheet. Right. So you can link adjusted values. Sorry. Adjusted sales, cost of sales. So likewise, you can take adjusted values. Right. Then effective tax rate, you see 30%. 30%. Then adjusted assets. Adjusted assets. Adjusted assets values. So you can take all the values, adjusted asset values, liabilities and equity. You see total assets 9,337. Equity and liabilities same, 9,337. Right. So when you are doing financial analysis, you should take these adjusted values. You should do the financial analysis based on the adjusted values. Right, because these values are appropriate for your analysis. Right, now we'll do the same for next year, 2020. You can check your answers. 2020. You see sales, cost of sales, gross profit, interest received. These are same. You see 2020. And we have adjustment to administrative expenses. So we have 4 adjustments. You have to remove the lease rent charge to the administrative expenses. Then you have to take depreciation. You have to adjust over depreciation. Right, so we have 3 adjustments. Then the adjusted administrative expenses, 2,162. Then adjusted distribution costs, same. We have another adjustments to finance cost, lease interest, and bank loan interest. So you have to remove the bank loan interest already charged and take the new interest 35. And you have to take lease interest 180. You see adjusted finance cost 221. Adjusted finance costs 221. Then adjusted profit before tax 2040. Adjusted profit before tax 2040. You see profit before tax before the adjustment 2078. But adjusted profit before tax 2040. You see profit before tax declined by 38. Profit before tax declined by 38. Then you calculate the tax effect. So how do you calculate tax effect? Effective tax rate multiplied by 38. Effective tax rate 30% multiplied by 38, you get 11. So when the profit before tax declines, tax expense decline. You see tax expense declined by 11. Tax expense declined by 11. Then profit for the period adjusted 1,428. Adjusted profit for the period 1,428. You see before adjustment 1,455. But adjusted profit before tax, profit for the period 1,428. You see profit for the period declines by 27. Profit for the period declines by 27. So this has to be adjusted to the retained earnings. When the profit for the period declines, your retained earnings decline. You see 2020 retained earnings declined by 27. Retained earnings declined by 27. Then adjusted retained earnings 2,173. Adjusted retained earnings 2,173. Right. Now let's see adjustment to assets and liabilities. You see property, plant and equipment is adjusted by lease asset and over depreciation 30. So lease asset after depreciation 1,200 is added here and over depreciation also added here. You see adjusted value 7,009. Adjusted value 7,009. Intangible assets, no adjustment. Current assets, we don't see any adjustments. So we have adjustment to lease creditors. It's 1,000. We studied last time. The current proportion of the lease creditors 264. Current proportion of lease creditors 264. We have adjustment to the income tax payable. We have adjustment to the income tax payable. You see in your income statement, income tax declined by 11. You see, income tax declined by 11. Then what happens is tax payable declines. Tax payable declines by 11. So tax payable balance, you see, declines by 11. Declines by 11. Then adjusted tax payable 178. 178. In addition, you see bank loan balance at amortized cost 220. So that is the correct value. Bank loan balance at amortized cost 220. The current proportion of the bank loan 100. Current proportion of the bank loan 100. Then the total assets equal to 11,116. Now you see assets are now at appropriate values. Your assets are now at appropriate values. Then total equity and liabilities 11,149. You see total assets 11,116. Equity and liabilities 11,149. You see 33 higher. Total equity and liabilities are higher than total assets by 33. You see 33. 33. The difference is 33. So this difference coming from the previous year. This difference coming from the previous year. You see your working number 3. Working number 3. You see at previous year 2019, we have recorded loan balance 400. But according to the amortized cost, the loan balance is 433. So that's brought forward to this year, 2020. Now you see, the loan balance was recorded at amortized cost. We studied last time. And I have asked you to study SLFRS 9, Financial Instrument Standard. So we recorded the loan balance at amortized cost. That's 33 higher than the loan balance given in your accounts. So this difference is brought forward to this year. You see, 2019 end loan balance 433, but the accounts shows loan balance of 400. So there is a difference of 33. So we have brought this 433 balance to this year, 2020. Now you see that 33 difference is brought forward to the 2020 year. That 33 difference is brought forward to 2020 year. So that's why your accounts has difference of 33. That's why your total assets are lower than total equity and liabilities by 33. So it doesn't matter. So what we need is assets and liabilities at appropriate values. So we need the financial statement items at appropriate values. Then you can do the analysis based on those values. So it doesn't matter we have 33 difference. It doesn't matter. Right. Now we have, you can check your answers. So we have assets, liabilities, equity, income, expenses at appropriate values. So these adjusted values, now you can take to that new sheet, adjusted financial statements. So you can link these adjusted values. So equal, you go to the previous sheet and take those values. 2020 adjusted values. 2020 adjusted values. Right. So take all the adjusted values. Then adjusted assets, adjusted assets. So when you do that, everything on Excel, it's very easy. You don't need to worry about calculations. Then adjusted equity. So we don't record the debenture premium. You can remember we adjusted the debenture premium. Right. Now you see adjusted total assets is not equal to equity and liabilities. It doesn't matter. So what we need is assets and liabilities at appropriate values. So we need financial statement items at appropriate values. Right. Similarly, you can continue the same. You can continue the same to 2021. You can continue the same to 2021. You see 2021. You see statement of income 2021. No adjustment to sales, cost of sales, gross profit, interest received. There's adjustment. There are adjustments to administrative expenses. You see lease rent 460. You have to remove from the administrative expenses, and you should take depreciation of 300. Depreciation of 300. You see adjusted administrative expenses 2,248. 2,248. No adjustment to distribution cost. And there's other expense guarantee 500. So this is a loss. Then to finance costs, there are some adjustments. Lease interest you have to take. Debenture interest you have to take. You can remember during 2021, there was a debenture issue. So we calculated debenture interest at amortized cost. So you have to take that. Then some adjustment to the bank loan interest. Right. So adjusted finance cost, you can check the answer. 852. Adjusted finance cost 852. Then adjusted profit before tax 1,931. Adjusted profit before tax 1,931. You see a profit before tax before adjustment 2,418. But adjusted profit before tax 1,931. You see profit before tax declines by 487. Profit before tax declines by 487. Then you can calculate the tax effect based on the effective tax rate. Effective tax rate is 30%. That's 30% multiplied by the change in the profit before tax, 487. You get a income tax adjustment 146. Income tax adjustment 146. You see profit before tax declines, therefore income tax declines. Income tax declines. Then adjusted income tax 579. Adjusted income tax 579. Then adjusted profit for the period 1,352. 1,352. Profit for the period before adjustment 1,693. You see profit for the period declines by 341. Profit for the period declines by 341. So this has to be adjusted to retained earnings. So when the profit for the period declines, retained earnings will also decline. So retained earnings declined by 341. Retained earnings declined by 341. So adjusted retained earnings 3,469. Adjusted retained earnings 3,469. Right. Now you see these are the adjustment to statement of income. These are the adjustments to statement of income. So you can check your answers. Then you see statement of financial position. To property, plant and equipment, we have adjustment of 900. So that's a lease asset. Lease asset. So 1,200 is the lease asset value minus depreciation 300. No adjustments to current assets. Then total assets 17,522. Then this debenture premium you have to remove from the accounts. So you can remember we should follow the amortized cost method. Debenture premium you should remove from the accounts. Then debentures at amortized cost. Bank loan 1,100. Lease creditor 704. The current proportion of the bank loan 100. Current proportion of the lease creditors 296. The adjusted tax payable 86. Adjusted tax payable 86. So how do you get 86? Income tax payable before adjustment 232. You see in your income statement, income tax declined by 146. So when income tax declines, tax payable declines. So tax payable declines by 146. Then 232 minus 146. You get an income tax payable 86. Income tax payable 86. Then there's a liability guarantee payable 500. Accrued expenses same. Accrued expenses same. So total equity and liability is 17,606. So you should check your answers. Total equity and liability is 17,606. But total assets 17,522. 17,522 total assets. But equity and liabilities 17,606. You see the difference is 84. The difference is 84. 84. Total assets lower than total equity and liabilities by 84. So how do you get 84? If you see the financial statements, you come to the tutorial. You see the financial statement notes. You see note number 6, additional information number 6. Additional information number 6, finance cost. Finance cost. So finance cost for 2020 48. Finance cost 2021 36. Now what we did was we have removed these values and we have calculated interest based on the amortized cost value. So we have calculated the bank loan interest based on the bank loan value at amortized cost. So we have removed this 48 interest and 36 interest. So 48 plus 36, 84. 48 plus 36, 84. So that difference is accumulated here. That difference 84 is accumulated to 2021. All right. So it doesn't matter. Your total assets is not equal to total equity and liabilities. Because what we need is financial statement values at appropriate values. We need financial statements at appropriate values. Right. Now you take these adjusted values to that new worksheet. So adjusted values for 2021. So you can link sales, cost of sales. Then effective tax rate 30%. Then adjusted assets. Adjusted assets. Liabilities and equity. Adjusted assets, liabilities and equity. Right. Now we have here adjusted financial statements. Right. So we have adjusted financial statements. So you can do the analysis. You can do common size analysis. You can calculate common size amounts based on these adjusted values. So you can do trend analysis. You can do a ratio analysis. You can analyze return on assets, return on equity. So all your analysis should be based on these adjusted values. Right. So thereafter, we are using these adjusted values to do your analysis. Right. So what you can do is, you can remember when you do a ROA analysis, we need separately operating items from financial items. You can remember, to calculate ROA, you need investment in operating assets. In addition, you need operating profit, tax adjusted operating profit. So what you can do is, you separate operating items from financial items. You see a statement of income. Now this is very important. Now after doing all your adjustments, so you should separate operating items from financial items in your accounts. Right. Now you see a statement of income. Sales, cost of sales, gross profit, administrative, distribution cost, other expenses are operating. Interest received, finance cost are financial. Right. So you should separate operating items from financial items. Right. So we'll do a separately. So you can copy these values, line items. So somewhere below these values, somewhere here. You can copy these line items. Right. Then you can restructure the financial statement presentation. Now we need separately operating items from financial items. So you can restructure financial statements accordingly. First you take operating items, then financial items. Right. So sales, cost of sales, gross profit are operating. Interest received is financial item. Finance cost is financial item. So below the finance cost, you can take interest received. Simply cut and paste the line item. Below the finance cost, you can take interest received. So sales, cost of sales, gross profit, administrative expenses, distribution expenses, other expenses. So these are your financial operating items. Operating items. So sales minus cost of sales minus administrative distribution costs are the expenses. So you get operating profit. Operating profit. So we have studied those. Operating profit before tax. So we call EBIT. EBIT. So we can take operating profit before tax or EBIT. Then you can insert another row. You can show the tax effect. Tax on operating profit. Tax on operating profit. Tax on operating profit. Then you have operating profit after tax. Operating profit after tax. Operating profit after tax. Right. Now these are the operating items. You see, these are the operating items. Right. So these are the operating items. Right. Now there's a question here. So do we find adjustment to every company? That depends on your understanding about the company. That depends on the understanding about the company and its financial statements. You can remember I gave you 3 weeks to study the company and financial statements. So if you have done that study during that period, so you can think of various adjustment to assets, liabilities, income, expenses, right? So you will find adjustments only if you have studied about the company and its financial statements. Otherwise, you don't find any adjustment. So that's why I'm telling you, I can understand from your assignment whether you have done such a study. Right. So remember, adjustments are unique. You don't find same adjustment in the every assignment. Adjustments to your company's financial statements are unique, are different from adjustment in the others' financial statements. Right. So that's why I have given you 3 weeks to study about the company, industry, and especially financial statements. Now you can think of various adjustments. So by looking at your assignment, I can find those who have followed my guidelines and those who have not. So those who have not followed the guidelines will lose the marks. Right. Right. Now we'll take the adjusted operating items. Now these are operating items. So you can link. You can link the value. You don't have to type the values. You can link sales. So these are the sales. Right. Then cost of sales, gross profit. Right. Then administrative expenses. Administrative expenses. You can link and find the value here. Distribution costs. Other expenses. Then you have operating profit before tax. Gross profit minus administrative expenses, distribution expenses, other operating expenses. Operating profit before tax. Right. So these are the operating profit before tax. Then how do you calculate tax effect? We have effective tax rate. You see, we have effective tax rate. So you can calculate tax effect based on the effective tax rate. Profit before tax, operating profit before tax, multiplied by effective tax rate. Operating profit before tax multiplied by effective tax rate. So you should make it negative value. Operating profit before tax multiplied by effective tax rate. Right. So you can round up these two complete values. You can round up these two complete values. Right. So these are the tax on operating profit. Tax on operating profit. Then operating profit after tax. Operating profit before tax minus tax on operating profit. So you get operating profit after tax. Operating profit after tax. So these are operating items. These are operating items in your statement of income. Right. So if you have any question, you can ask now. Right. So these are operating items in your statement of income. Right. Then we'll take financial items. So we have finance cost. Now we don't need these values. Profit before tax value, we don't need. So financial items are finance cost and interest received. So you can take the values. You can take the values from the adjusted financial statements. So finance cost 41, 221, 852. So you can link the values. Finance cost. Interest received. So you can link. Right. So these are interest received. Right. So these are the two financial items. Finance cost, or you can say interest expense, and interest received, interest income. You can take, you can say interest expense and interest income. So instead of interest received, you can say interest income. Interest income. Right. Then you take the difference between finance cost and interest income. So we call it net financial expense. Net financial expense. So difference between finance costs and interest income is a net financial expense. How much? Next, net financial expense. You see a 32, 216, 762. Net financial expense. Right. Then you have to adjust the tax effect. Adjustment for tax effect. Adjustment for tax effect. So we have effective tax rate. So what we do is this net financial expense multiplied by effective tax rate. Effective tax rate. So net financial expense multiplied by effective tax rate. So we have the effective tax rate here. Net financial expense multiplied by effective tax rate. Now, when you have an expense, what happens is tax savings are there. You see your finance cost higher than the income, finance income. So you will have tax savings. Tax savings. Now you see all the 3 years, finance cost is higher than the interest income. All the 3 years, finance cost is higher than the interest income. So you have tax savings. You have tax savings. Therefore, these tax effects are positive. These tax effects are positive. Right. So you put minus. You put minus in front of the calculation. Equal minus. Right. Then you get the positive values. Positive values. Right. So we'll round up to a complete value. Right. So tax effects are positive. Then you can take tax adjusted net financial expense. Tax adjusted net financial expense. 2019-22. 2020, 151. right? So tax adjusted net financial expense. So if you have any question, you should ask, because this is very important. So this is really a practical thing. This is how you do analysis in practice. You can't just take the financial statement and do the analysis. That's entirely wrong. So you do relevant adjustments. Then you should reorganize the financial statements. Right. Now you see, this is how you reorganize financial statements to suit for the analysis. Right. Now we have adjusted the financial statements. You see, these are our adjusted financial statements. Then we have reorganized. We have reorganized the financial statement items to suit for the analysis. Right. So this is very important. Right. Then profit for the period equal operating profit after tax plus tax adjusted finance expense. You see, operating profit after tax plus tax adjusted net financial expense equal to the profit for the period. You see, profit for the period 2053, 1428, and 1352. 1352. You see, we had the same answers earlier. Earlier, we got the same profit for the period. You see the adjusted financial statements. Adjusted financial statements. Profit for the period is the same. Now you see, we have reorganized. We have just reorganized the financial statement presentation. You see, the profit for the period same. You see, it's same as before. Same. So we have reorganized financial statements. Right. So these reorganized financial statements we call reformulated financial statements. You can write down on the top of these reorganized financial statements, you can write down reformulated financial statements. Reformulated financial statements. Right. So these are the reformulated financial statements. Right. So we have simply reorganized our adjusted financial statements to suit for the analysis. Right. So we have calculated profit for the period. So how do you calculate profit for the period? First, we got the operating items. From the operating items, we calculated the operating profit after tax. We calculated the operating profit after tax. Then we have financial items, finance income and finance expense. Then we have adjusted for taxes. Then we have net financial expense after adjusting taxes. Then operating profit plus net financial expense, operating profit minus net financial expense. So we have profit for the period. Profit for the period. Right. Now we have reorganized our financial statements. Right. So this is what, for these are the financial values most suitable for the analysis. So these financial statements are most suitable for the analysis. These reformulated financial statements we should use for our analysis. Right. Then let's prepare or reorganize statement of financial position. So you should first take the operating assets. So you can write down operating assets. Operating assets. So you can take operating non-current assets and operating current assets. Right. You know, operating assets are two types. We studied last time. You can remember we studied. Company invests in non-current assets and company invests in working capital. You can remember the company's total assets investment or total investment assets, investment in assets are two types. The total investment in company's assets are two types. Non-current assets and working capital. Non-current assets and working capital. So you should first take the operating non-current assets, then working capital. You know, working capital equal current assets minus current liabilities. So we have current assets here. Then you should take operating current liabilities. Operating current liabilities. So in your current assets, now this is very important. In your current assets, investment in marketable securities, are financial assets. Investment in marketable securities are not operating. They are financial assets. You know, it's financial instrument, financial security. Therefore, we should not take under operating assets. It's coming under financial asset. Right. So operating current assets are now inventory, trade debtors and cash. Inventory, trade debtors and cash. Then current liabilities. Current liabilities. So what are the operating current liabilities? You see, these are the current liabilities. You see trade creditors operating. But bank loans, leases, financial. Tax payable operating. Payable for guarantee, let's take as operating. Accrued expenses operating. Now you see only operating liabilities are trade creditors, tax payable, payable for guarantee, and accrued expenses. So under liabilities, under current liabilities, you can take those operating current liabilities. So you can copy and paste. Operating current liabilities. So we have non-current assets. And operating assets, we have non-current assets. Then operating current assets and operating current liabilities. Right. So let's take non-current assets. Non-current assets. So you can link the relevant values. Property, plant and equipment. Intangible assets. Inventory, debtors. Inventory, debtors, and cash at bank. Cash at bank. Then current liabilities. Current liabilities. Trade creditors, tax payable, guarantee payable, and accrued expenses. Trade creditors, tax payable, guarantee payable, and accrued expenses. Right. So you take total of non-current assets, total of current assets, total of current liabilities. So investment in total investment in non-current assets. Investment in non-current assets. Non-current assets. Now you can take the total. So how much total investment in non-current assets? Take the total of property, plant, and equipment and intangible assets. So these are your long-term investments. These are your long-term investments. Then total current assets. And take total current assets. And total current liabilities. Total current liabilities. Total current assets and total current liabilities. You know, difference between current assets and current liabilities is the working capital. So we call it investment in working capital. Investment in working capital. So investment in working capital, current assets minus current liabilities. Total current assets minus total current liabilities. Total current assets minus total current liabilities. So that's investment in working capital. Investment in working capital. Right. Then investment in operating assets equal investment in non-current assets and investment in working capital. The total of investment in non-current assets and investment in working capital. So we call investment in operating assets. Investment in operating assets. Investment in operating assets. So that's total of non-current asset plus working capital. Non-current assets plus working capital. Non-current asset plus working capital. Right. Now you see, these are your operating assets. So you have invested in non-current assets. So non-current assets generate benefits over a long time period. Your non-current assets will generate sales over a long time period. In addition, we have working capital to run day-to-day operations. You have studied in finance, working capital management. So we have investment in working capital to run day-to-day business. The total is investment in operating assets. Investment in operating assets. Right. Then you take financial assets and liabilities. You take financial assets and financial liabilities. So you can insert some rows here. You can insert some rows here. You first take financial liabilities. Financial liabilities. Then financial assets. You can take first financial liabilities because now operating items we have taken. Operating assets and liabilities we have taken here. Right. Then financial liabilities and assets. Now you see financial liabilities are debenture, bank loan, leases. These are financial liabilities. So you can take these debentures, bank loan, leases. So under non-current liabilities, we have financial liabilities, debentures, bank loan, leases. So you can take these values. You can take these values. Under non-current liabilities, debentures, bank loan, leases. So these are the values. So you don't need to type here again. You can link relevant values. So these are financial liabilities. Long-term financial liabilities. Right. In addition, you see under current liabilities, some financial liabilities. You see under current liabilities, some financial liabilities. You see a current proportion of lease, current proportion of bank loan. These are financial liabilities under current liabilities. Current proportion of lease, current proportion of bank loan. So these comes under current liabilities. These come under current liabilities, but these are financial liabilities. Financial liabilities. Right. So these are your financial liabilities. Then financial assets. Financial assets. So we have one financial asset. You can remember investment in marketable securities. Investment in marketable securities. You see, investment in marketable securities. It's a financial asset. Under financial assets, you can take these investments in marketable securities. Right. So you take total financial liabilities. You take total of financial liabilities. Take total of financial liabilities. And total of financial assets. So we have only one. We have only one. Right. So total financial liabilities and total financial assets. Right. Total financial liabilities minus financial assets. We call net financial liabilities. Net financial liabilities. Total financial liabilities minus financial assets. We call net financial liabilities. So total financial liabilities minus financial assets. We get net financial liabilities. Net financial liabilities. Now you see, we have organized first operating assets. So we have operating non-current assets. Then investment in working capital. Operating current assets minus current liabilities related to your operations. Right. Then the difference between current assets and current liabilities, we call working capital. Then the investment in operating assets equal Non-current assets plus working capital. Non-current assets plus working capital. Now you see we have separately, now this is very important. We have separately operating assets. Now we have operating assets here. Now these are the operating assets. So these are the assets that are related to your operations. So these assets are used in your operations. Your non-current assets and working capital are used in your day-to-day operations. Then the result is your operating profit. The result is operating income and expenses. Your operating profit. Now you see, these operating assets results in operating profit. You see, how do you calculate operating profit? Sales minus cost of sales, gross profit, minus administrative distribution costs, other expenses. Then we have adjusted taxes. So you have operating profit after tax. So your operating assets result in these income expenses. These operating income and expenses. The result is operating profit. Right. Now you see, after reorganizing, you can properly match. You can properly match your operating assets with operating profit. Right. So these operating assets result in these operating income expenses. Now you see, we have separately operating assets. These assets result in operating income and expenses. Operating income and expenses. Right. Now you see, after reorganizing your financial statements, so you can do a very good match your operating profit with operating assets. So you can do a better match between your operating profit and operating assets. So this match is important when you do ROE analysis. Right. Now you see, we have adjusted the financial statements. Then we have reorganized the financial statements. So once you reorganize, you see, you can properly match your operating assets with operating profit. You can properly match your operating assets with operating profit. Then after operating assets, you see financial assets and liabilities. You see, after operating assets, you have financial assets and liabilities. So these are financial assets and liabilities. So you can match these values with finance income and expenses. You see, after operating income expenses, you have finance cost, finance income, and tax adjustment. You have a tax adjusted net financial expense. So these are the results of your financing items, financial items. These are the results of your financial items. Financial liabilities result in finance cost. And financial assets result in finance income, interest income. You see, interest income is results of your financial assets. Interest expense or finance cost is a result of your financial liabilities. Now you see, your financial assets liabilities here after operating assets, you can properly match your financial assets and liabilities with finance income expenses. Now you see, after reorganizing, you can do a better match between your financial asset liabilities with finance income expenses. Because your financial asset liabilities result in finance income expenses, right? So your finance income expenses relate to financial asset liabilities. Your operating income expenses relates to operating assets liabilities, right? Now you see, this reorganization, reorganizing your financial items result in better match between your assets liabilities with income expenses. So you can do a better match, right? So this is very important when you do ROA analysis, ROE analysis, right? So we'll do that part. Then the last item is equity. So we have taken all assets liabilities. So what remains is equity. Equity. Now calculate the total equity. You calculate the total equity. So equity, stated capital, retained earnings, there's no debenture premium because that's zero. Stated capital, you can link and calculate. You can link the relevant values. Stated capital, then retained earnings. So you can take the total equity. Total equity. Total equity. Right. So your total equity should equal investment in operating assets minus net financial liabilities. You see, investment in operating assets 2019, 7,170. Net financial liabilities 383. Then 7,170 minus net financial liabilities 383 should equal total equity. So let's see, you get the same answer. 7,170 minus net financial liabilities. You see 6,787. So that's equal total equity. That's equal total equity. Now we'll see the rest of the years. You see 8,140, 9,385. So something has gone wrong. Now there's a difference. So we should check why there's a difference here. we should check the financial statements. We should check the financial statement. All right. The difference is from the differences in the adjusted financial statements. You see, in the adjusted financial statement, 2020, 33 difference, and 2021, 84 difference, 33 and 84. You see 33 and 84 difference. So these differences are coming from those adjusted financial statements. Right now, you see, we have reorganized the financial statements. Now, you see the things we did for this tutorial. So we had the financial statements. Then we have adjusted those financial statement values to bring asset, liabilities, income, expenses to appropriate values. Right. So after doing the accounting analysis, after doing the adjustments, we have financial statements at appropriate values. So those adjusted values, we are going to do the analysis. We are going to do the analysis based on those adjusted values. But before the analysis, now you see, before the analysis, we have reorganized financial statement to do a better match between operating items and financial items. So this is really important. So after doing relevant adjustments, we reorganize the financial statements to do or to have a better match between operating items and financial items. So that's your learning point here. So your operating items, you can match with these operating assets and liabilities. Now you see it's in blue color. Your operating income expenses are in blue color here. You can match with operating assets and liabilities. Operating assets and liabilities. Your financial items here, financial income expenses here, you can better match with financial assets and liabilities. Right. So after reorganizing, you can have a good match between operating items and financial items in your financial statements. Right. So this is today's learning point. So remember, we should get the adjusted values first. Right. So in your assignment, you should follow this kind of procedure. You should get the adjusted values first. After doing all necessary adjustments, you should reorganize financial statements to do a better match between operating items and financial items. So this is very important. So we have to prepare. You have to prepare reformulated financial statement. Right. This is what we are going to use in our analysis. Right. Any questions? Now you should practice this. You should practice this. Right. So next time we are going to analyze these financial statements. So next time you should come with reformulated financial statements. So we are going to study some kind of analysis. Right. So if you should have next time these reformulated financial statements. So in a separate Excel sheet, adjusted financial statements. So you should have these reformulated financial statements. So next time we'll do some analysis. Now you see first accounting analysis. So in the accounting analysis, you do adjustments to financial statements and you reorganize the financial statements. Then you can start the financial analysis. So next time we'll study some financial analysis for these reformulated financial statements. Right. So any questions? Any questions? Right. So you should try this by yourself. Right. So I'm not sharing this Excel sheet. You should try by yourself. Because whatever the question you have, you can ask. Right. So I can explain it. Right. Since there is no question, then let's meet next time. You come with the reformulated financial statements. Right. So we'll study the analysis. We'll study the analysis. Right. Right. Then see you next time.
Thank you, sir.
Thank you, sir.
Thank you, sir.
You're welcome.